Friday.
Oh, happy Friday.
All right, so this is going to be a pretty, in my opinion, pretty important session for us here. And it's going to be leaning into the conversation that we have with our clients. And I'm going to start the presentation with a little video clip here, which I don't normally do, but hang on for me. All right, so in today's session, I'm going to talk about the big picture of the housing market and how we can communicate, or how we should communicate that to our friends, family, sphere of influence, clients, past clients, future clients, leads, everybody. Okay. And I'm going to give you some very recent quotes before I play my little video clip. The first one is from Fannie Mae. And this one says, there are far too many people coming up in age, and certainly many already there, that want to own their place. According to the latest projections from Fannie Mae, 6.8 million homes, both new and existing, are expected to be sold by the end of 2021. And this was published in 2022. Okay. So they're predicting that the demand side is going to be steady. Okay. And I think sellers are now, inventories coming in. Over the coming 12 months, CoreLogic predicts that home prices, and this is just 3-4 weeks ago, will rise by 5.9%. And that's a 12-month window. And I think everybody was predicting, and this is going back to the beginning of 2022, before all the rates increased. They're predicting 9% for this year and a more normal 3 to 5% appreciation going forward. I think what we see here is the media is grabbing a story, and the media is trying to take control of the narrative to the home buying public. And I think that's a dangerous paradigm for us. Okay. During this presentation today, I'm going to show you like arguments for and against a housing correction, what a correction means, because I think even a housing correction is misunderstood by most, including many professionals in the industry. So everybody on this call coming on 9:30 on a Friday morning in the summer is a committed professional, and you will understand, and I hope you'll appreciate this excerpt from a clip from Elon Musk. Okay. And this will frame our mindset for going into the future here. So hold on. Let me take it. Can you guys hear it?
No.
All right. Let me
No.
Let me reshare it here.
Yeah, can't hear.
All right. I'm going to fix that. Share computer sound. And this is, I believe he's probably still the wealthiest man on the planet. And he's talking about executing his passion and his vision. And it's only going to be a very brief clip.
They went through some super tough times.
Can you hear it?
Yes.
And in fact, for SpaceX, I reserved capital to have 3 launch failures, or to withstand 2 launch failures and have the third one be a success, sort of 3 strikes. And actually, we had 3 launch failures. We were just able to scrape enough money together for a 4th flight that succeeded in 2008. And also in 2008, as Steve knows, we got the Tesla financing round done on the last hour of the last day. It was like 6 p.m., December 24th, 2008. And if we hadn't gotten it done then, the company would have gone bankrupt a few days after Christmas.
So who knew? And if you ever take study of, most successful people, it's not their successes, it's how they deal with their failures or when they get to the precipice. And he goes on to talk about it, and I'd encourage you to take a look at it, about all the times that the company, both SpaceX and Tesla, were on the verge of being worth zero, bankrupt. So take a look at that. I'm going to share my screen now with regards to let's see here. So can you guys see it now?
Yes.
So I want to ask, what does a housing correction mean? We have lenders and professional agents here. What does a housing correction mean? If somebody wants to take a second to just tell me what that is.
I was looking, this is Jim. I was looking at some quick numbers yesterday on the local plantation market year to date in April compared to last year. A good example was we're running at about a 20 in plantation and about 28% increase over last year. And to me, a correction is going to be a more normalized market. Eventually, we're in that 8 to 9%, or maybe 5 to 6%. But seeing a 26% increase is not a normal, normal.
So Jim, thank you for sharing. I want to, and I'm going to come back to you, but I want one or two other people to share with me what's the definition of a correction mean.
Less of a panic, it's less of a drop. It's an adjustment versus versus the opposite.
All right. Any other brave souls want to
Versus a
define?
crash, I'm saying versus a crash. I mean, the correction is just, things aren't gonna end. It's just, holy cow, you got to turn back. It's kind of like what's going on with inflation. You got to get it under control. I mean, houses can't be $7 million in 10 years. What the hell? I mean, got to get it under control.
Okay. How about one other volunteer here?
This is Caitlin. It means that it's the end of the housing boom and it's a peak. So things start normalizing in whichever way that things were moving. So whatever peak was happening, it meets that peak, plateaus, and starts leveling off or heading down.
Right. So I think when the public hears the word we're looking at a housing correction, I think they look at that in the lens of a boom or a crash or a deflationary segment for housing. Would you agree with me that John Q and Jane Q public probably look at it that way? And is it in the media's interest to make it more dramatic than it is in most cases?
They sell advertising. That's what they do.
Right.
Yes, like everything else.
Nobody wants to tune in for a housing market. Looks like it's in for a normalized, stable next 3 years, right? That doesn't keep eyeballs on the television. That doesn't attract people to a blog. I truly believe. I truly believe, Jim, I believe that the public thinks a correction is I'm going to have a fire sale to buy houses. Would you agree that, absent us educating and controlling the narrative, that might be what a percentage of the public thinks is coming down the road?
I think that's what the media is trying to do right now.
The media is very cagey in the way that they present it. They talk about a correction, but nobody's really saying, I've seen some dramatized, blogs and things saying, oh, some of these overheated markets are in for a correction of 8 to 15% based upon, a series of calculations. And I guess it's possible some of the, overdone markets might correct downward slightly in prices. But I think a correction means moving towards the norm. Okay, as opposed to a crash, as opposed to, I'm going to have leverage as a buyer all of a sudden tomorrow because the rates went up. I don't see it. And I think that we have to control the message to our clients. And I'm going to present in today's session the argument for both ends. And I want to be able to have a honest conversation. And here's where we need to thread the needle. We're talking to somebody who's a buyer and the seller, or we're talking to a seller who has a family member that's coming up into talk to us next, who's a buyer. And how do we have that message that has integrity, that has a cause of action, that people move, okay, without telling half a story to one side and half a story to another. Would you agree that that would be a really valuable resource to have?
Sure.
Where, you're going to your sellers, hey, put it on right now, the prices might fall. Then you're telling the buyer, hey, we're going to see normal appreciation. You might seem like a bit of a hypocrite, right? So,
Yeah.
I think a better word for instead of correction would be adjustment. I think it's softer.
okay,
Hmm.
we're gonna see
So-
an adjustment.
So I pulled up a definition of so if I can read it real quickly, of a correction. If you don't mind, it's just a real estate correction is relatively minor drop in the market. The market's in a correction territory when the home price index falls not more than 10% from the highest price within a year. So when you take like the numbers that I just mentioned, 28%, and then drop it by 10%, we're still way above. And
So
talking
Jim, is that a reduction in price or a reduction of appreciation?
10%, it's when the index falls more than 10% from the highest price within a year. So then they talk about a crash when the index falls more than 10% for a 52-week period. That's a crash. So if the home values drop 12%, 15%, that's what they're considering a crash.
Okay. I don't know that I don't know that I buy into like there's an official definition, but I appreciate the narrative there. I think a correcting market could be something where, instead of having, 18 buyers to every home on the market, we might have 4, or we might have 2, right? So that's a correction. But, when we look at pricing, we need to be really clear with the people who have faith in us and follow us. Okay. A correction, in my opinion, is, hey, we've been appreciating at 12 to 20% the past 2 or 3 years. A correction might mean we're going to go to 3 to 5% appreciation. And if that's what the anticipation is, what does that define, or what does that suggest that a rational buyer should do? And that's what we're going to go into. So let me put on my presentation, because I'd like to kind of go through this.
Okay.
So if you were to go back to 2021, okay, where you had the actual was in the 20% range. Okay, so we're going from 20 down to 9, down to 4, down to 3. Now, if you look at this without the right context, you might be, oh, housing is crashing, right? But not really. The rate of appreciation is normalizing. Is that not a better way of communicating that? And if anybody followed the comments from Jerome Powell, the Federal Reserve chairman, he was very deliberate in saying that, part of what they watch is the housing market. Okay. And he felt, and I'm reading between the lines, that a slowdown was a good thing, because it then made housing more accessible to everybody. Now, it seems to be a paradox, because now housing prices are going up, so it seems to be less affordable. But I think the long-term trajectory of what he's doing is net positive for housing. Okay, it's leaning towards avoiding a crash, as we call it, where prices actually decrease. And I'm going to go into that for a little bit. So I believe we're in for a period of slowing appreciation. And I believe if you look at data and you look at that logically, rates are a little bit higher. Demand is still favor the seller. So that means that there's still more people needing homes than need to sell. Now, the case for a housing correction, or maybe even a crash, would be affordability is on the decline. Number 2 is sentiment, and who controls the sentiment, especially if you have somebody that you're working with. If your clients are saying we're going to sit on the sideline for a while, I think that might be due in small part or large part to our not controlling the narrative or not controlling the message. Would you all agree?
Absolutely.
Okay. People talk about the wealth effect. People talk about, rising rates. You might even want to put, and this one goes both ways. Inflation's a big topic nowadays, right? Quantitative tightening. And who's on the call that's not one of our lending affiliates or partners that wants to tell me what quantitative tightening is, if you know? Does anybody know? Rob Garver, you want to give it a stab, or you don't not comfortable with it?
I really am at a loss. I'm sorry.
Okay, so
I have an idea, but I'm probably going to get it backwards. Is
Okay.
it when the government starts pulling money back rather than putting money in to the economy?
that's correct. And Bruce, if you could back me up on this, because I might not have everything correct, but I think that
Not all Greek to you, JT. You got it.
TJ, yeah. So
I said JT, what's the matter? Sorry, TJ.
yeah. So is it $100 billion a month that they're pulling out of the fixed income or mortgage-backed security market, Bruce? Is that what the headline was?
Funny you should ask. It's a big part of why this thing is getting squirrely too. It's they're just going to continue to not roll, and it's going to be it's going to total way over 100 billion, all in. But it's really what that means in English is that the mortgage-backed securities, when the market got really crazy, when the pandemic first started, I don't know if anybody recalls, but when the pandemic first started, interest rates went up almost 2% as well. Does everybody remember that? I do, because I was ready to jump out a window. I've never seen it. It was crazy. It was like in a couple of days. And then fortunately, the Fed came in and said, "Oh, we're going to buy mortgage-backed securities. We're going to invest in keeping real estate there." So the Fed just started buying mortgage-backed securities for a long time. And that's really what happened. They stopped doing that in December. So now what's happening is they're putting all this money back into the market. They're getting out of it. They're easing out of it. So they're trying to let the markets absorb it. And the market is scared, because of what's going on with inflation and all this uncertainty. So that's kind of what's going on. And the Fed reiterated that. Powell reiterated that yesterday. He said, we're still going to bail out of these, buying the bonds. So it's in other words, they're pulling out of what they did to fix it. And they're waiting for the market, hopefully, to absorb it and, find its way.
So I think that they're at like over $1 trillion that they've invested, Bruce. And I think they're talking about instead of putting, back in August of last year, they were buying $100 billion worth of mortgage-backed securities to prop up the market. Okay, now they feel
it was 2 trillion worth of, it was over 2 trillion all along. Yeah.
So it's a massive number.
Well, we
Now
had a
with the-
4-point-something trillion dollar year, so it was half the market, just to be clear, like a significant number.
Yeah, so now not only are they not propping the market up with interest rates, but they're actually pulling away and letting others buy, which is depressing the prices of the securities, causing rates to go up. A very rational argument could be made that once the Fed backs out of the selling, that the market would be really strong. This is a pretty good stress test that it's holding up as good as it is, right, Bruce? Because sometimes markets seize and they freeze up. And when I spoke to you the other day, you were like, I couldn't believe what happened. We lost 3 points in a day. I think you might see that because there's nobody backstopping the market. Like
it's all fear. The other day was just Wall Street saying, we don't know what the hell to do. I mean, really, that's what it was. And I hate to put it that way, but that was right before, and then when the Fed made their announcement, things, the good news is what the Fed did got back almost 90% of what we lost, thank God, in just 2 days. So yeah, it's hard to explain to clients too that, when the Fed raises rates, it helps mortgage rates, but whatever, we'll get into that another time.
So quantitative tightening is not only is the Federal Reserve raising interest rates, but they're pulling out their support for the mortgage-backed market, which is further causing mortgage rates to disproportionately trend higher than they otherwise would if the interest rates just went up.
And also the quantitative, you could also argue that, no more stimulus is also part of quantitative tightening, because quantitative easing is when you put in, when you invest, and when you do all this, and the pulling out, all this stuff's getting pulled out.
Yeah, so I mean, it's not just the stopping of investing in, it's a reversing and pulling out. So it's the adverse effect. So new inventory is another one that I want to just put on the table here, because your clients are sure to be able to press you and ask you questions about this. Based on my research, which was pretty thorough, there's 18 to 20 million single family homes owned by investors. Okay. And there's approximately 84 or 85 million single family homes nationwide. So that's 21 to 23%. Some of the pundits say if 5% of these investors get spooked by the market and they put it onto new inventory, it's going to tremendously change the inventory in the market. Okay, so if just 5% get spooked and put it on the market, that's 1 million new homes for sale, like that. Another conversation that the correctionists are saying is that the builders have a backlog of homes pending completion that were delayed due to labor and supply chain challenges. And I think we all can probably appreciate and understand that intellectually. And the third one for inventory is foreclosures. I'm not an expert on it. I would not, look to have a career as a foreclosure specialist in New Jersey, Florida, or any of the markets I looked at. However, on the fringe, they appear to be, coming back to impact inventory a little bit. This is a quote I found online. I put I footnoted where I got it from. It says New Jersey trailed only Illinois for the highest foreclosure rate in the United States in the first quarter of 2022, as backlogs from the moratoriums continued to clear. And I think Governor Murphy probably caused this by putting extended moratoriums on, but I don't think it's a significant impact that's going to happen. So 1 in 792 housing units were in foreclosure over the first 3 months of the year, a 69% increase from the fourth quarter of 2021. That's like 1 in 800. Doesn't seem to be that significant to me, but if you look at if it was 1 in 2,000 to 1 in 800, that's a massive increase of nothing. Does anybody else have anything on the argument for a housing correction or a crash that you wanted to introduce and have a discussion about?
The one thing, again, Jim here, the one thing I would just say is we're talking to our clients and, we're looking at something in its entirety as opposed to the specific neighborhood. When someone says, hey, how's the real estate market? Well, it depends, Rob. Tell me where you live and let's look at your neighborhood, because your neighborhood's going to be different than other places that you're hearing about in the country. So it's important that we talk to our customers and educate them, as you said, having that conversation with them, because every neighborhood and obviously Florida is very different. We're not seeing.
I mean, and every sub-market as well, Jim, if it's a multifamily, if it's an adult, if it's a condo, a townhouse, a golf community, I think every market has different attributes to it. And we need to be prepared to have those discussions.
Correct.
And we need to
Not only that, but the buyer traffic, Rob, the housing, the data that came out yesterday was the housing market index. It measures everything above or below 50, above 50 being favorable, below being, unfavorable. And for the first time in ages, the housing traffic, which is by definition what we understand it as people coming out to see homes, is down. It's at 48. It's below 50. So the sentiment is out there. People are concerned. So that's definitely there.
So, go ahead.
No, just real quickly, in my conversations, I think, and for everyone, you need to become very in tune with the condo market and with the laws that are passing because of the Champlain Towers collapse. It's going to have a huge effect on the market, especially in South Florida, but it's not just South Florida. It's going to be all over the country. So it's really important to take the time to learn about a community when you're presenting it to a potential buyer, financially what's going on with the community. So many people, so many agents just overlook that, and we're big surprise on that market.
So,
I think, sorry.
go
I
ahead,
think
Connie.
Jim, okay, I think Jim is correct. I think this is a time where our knowledge of the market and what's going on is going to set us apart from the competition. I think we need to have the answers, and we need to know what we're talking about.
So,
Build trust.
I think we need to set the right expectations as well. I'm going to talk about two experiences in the past week. One is one of our teams here in Westfield just put on, today's Friday, on Wednesday, 4 listings in one day. Okay, because they felt that the consumer was now looking for that guidance and that story and that narrative that we are able to control. And they didn't feel like the party would go on forever, which I think is a healthy thing. Second thing is, I had one of our Morris County agents had a listing, and this is 6 or 7 weeks ago now. It went on the market at $750. Okay, had multiple offers. The highest offer at the time was $860. By the time they got back and talked to everybody, that person had made multiple offers and decided that that wasn't the house that they wanted. The true price that it settled at in contract was $820, $70,000 over a $750, almost a 10% premium. Now, the buyer, how dare they ask for some reasonable concessions based upon a home inspection, which was not waived. And the seller, over a $7,000, came down to $7,000, decided to walk away from it. House goes back on the market. The first week, 0 offers, very limited showing. The second week, about the same amount of showings. At the end of the second week, when they felt that it was crisis mode, 3 offers came in. One of them was over 800, not 820, but they were able to pull it together. I'm not sure what that means, but I think it kind of goes towards we're not in full out panic. We do need to educate.
When was that, Rob? When it was a week and a half ago, a week ago? When was that?
So 6 to 7 weeks ago, it went under contract, and in about 4 weeks, they determined that they couldn't come to terms. 4 to 5 weeks, they determined that they couldn't reconcile the home inspection items. And this was a $7,000 number it came down to. And they were like, Mr. and Mrs. Seller, for $7,000, we can close this in 2 weeks. They're like, we're not giving the $7,000 away. We want to go back on the market. Very irrational decision. 2 weeks on the market with no offers. Then all of a sudden they had 3 come in, one of them slightly over 800. And we're hoping that that continues and closes. But I still think if you have listings that are priced reasonably, we're going to find the buyers and get them sold. It might not be, 8 to 15 offers in the first week. We might not be able to say highest and best by Wednesday after a Sunday introduction to the market. And I think we need to change the way that we communicate that to our clients. Does that make sense? And this does not mean that we're in panic mode. I think in retrospect, looking at this story, the agent really felt that after a week, we're in big trouble, right? And in 2 weeks, they did wind up getting 3 offers, and there was probably only 12 showings, maybe 10 showings. So 10 showings, 3 offers, 50,000 plus over ask, I think is still a very healthy market. Okay. But these things are the things that I think we have to, control. We can't let the sellers believe that, what happened 3 months ago is going to continue. We need to be more deliberate. We need to be more intentional on our pricing. We need to let sellers know that, 3 offers is enough. 1 good one works, but, if you only have 1 good one, you have limited control over the process, right? And having these discussions, I think, are tremendously healthy. And, you know, I think it's no longer optional. I think we must have those conversations if we want to be able to, you know, manage expectations and close transactions with excellent customer appreciation and basically excellent reviews for what we're doing. I'm going to go back to my document for a strong housing market, because here's where the meeting gets to be a little bit more upbeat. The case for a question. Okay, the case for stable appreciating home values. The crazy appreciation may be gone, but we're not going to crash. Okay, if you decide that you're not going to buy, does anyone on this call feel that rent is going to decrease? Anybody? Okay, so I'll take that as a no. And I was actually watching on the local news. I think New York City has 1 million housing units that are subject to rent control, and they're going to have the highest increase in the rent control properties in 40 years. Home equity is at an all-time high. Okay, 38% of homes in this country have no mortgage whatsoever. Okay, mortgaged homes have 45% equity. That's a 55% loan to value. And this increased 35% in the past year. Housing shortage. Okay, does everybody remember the housing shortage that we spoke about 6 months ago, a year ago, 3 months ago? All these new millennials coming into the market. We haven't built enough homes in the past 14, 15 years. Do we all remember that?
Yes.
How does that disappear? I mean, let's be reasonable. How does that disappear? I know sentiment is changing, right? Because the public is you know, disturbed by inflation. They're intimidated by headlines, but they still need a place to live, right? They still need a place to live. Rates are still historically reasonable. Okay. And if the Federal Reserve and the interest rates rise so high that the housing market seizes, what do you think the Federal Reserve is going to do then if, you know, housing sales come to a grinding halt? Anyone?
Cut the rate again.
They're going to cut the rate. They're going to want to see housing be something that can trade. Do you not think it's a public policy that the federal government wants people to buy houses? I think they want them to do it responsibly so, but I do think they want them to buy houses. Okay, and I think if the housing market seized up, that would be horrible for politicians. That would be a horrible event. Okay, and
the economy.
Yeah, which I mean, I don't know, Colleen, if you remember, there used to be a statistic, and I wish I knew it, but like when somebody buys a house, the amount of money that goes into the economy from them, you know, from paying for the mover, painting the house, getting new furniture, like it's a massive amount of
Huge.
consumption that happens when you buy a house, right? We talk about price stability, price appreciation on homes. I want to just look at it through a different lens. Everybody's aware of what's going on in the car market, right? Auto market. Prices are through the roof. Now, does anyone on this call think that new cars in the next, you know, 6 to 18 months are going to be dropping like a rock? Anybody?
I think maybe they'll take off the high premium. Now, when you go to get a car, you see the sticker price, because my kids are looking for a car. You see the sticker price, but it's instead of them lowering the sticker price, you know, like they used to years ago, they add $10,000 to that sticker price.
And I believe that that's been coming down slightly, Colleen, as supplies and the ability to deliver cars are, you know, moving towards normalizing. They're being able to get some chips. They're being able to
Market
finish a little bit. They're being able to finish more cars. But with everything that we know, like the supply shortage, the cost of diesel fuel to get stuff to the factory, the cost of taking the car from the factory to the dealership, I don't think it's reasonable to assume or expect that auto prices are going to decline. I do agree with you, Colleen. I think the markups on those cars are going to start to go away. But I think the markups on those cars are there, Colleen, because dealerships need to make ends meet, right? And if they used to sell 150 cars a month, now they're only getting 35. They have to add that premium to keep people employed and keep the lights on.
Stable. Yeah.
So
I agree with you.
I don't see auto prices coming down. I think the inflation word, there is a little bit of a recession or a little bit of a retraction in like lumber prices from the completely ridiculous to, you know, moderate inflation over time. And, you know, they came down a bit, but they completely spiked because there was a shortage.
The
So,
interesting thing about auto prices, because I have some friends in the auto industry because I came from Detroit, is that it's actually the materials are costing them more, but the labor is actually less because they're so automated. But the price of the cars continues to go up. The profit margin is pretty good on cars.
you know, that's a conversation for a different day. But I do think, Colleen, I haven't seen robots building houses yet.
No, we're in good shape.
So, you know, the Fed is
Just
watching
like
how.
you can't have a robot sell a house, you know?
Yeah,
Rob,
yes.
Rob, I have a question for Bruce. Do you, as a mortgage, do you see homes are coming back on the market for buyers that were in a mode waiting for closing, and they cannot qualify for the mortgage that they applied for since the rate is up? So if the monthly payment before was $1,500, now it's going to be $1,900, and therefore they cannot qualify to close.
So I would say that, you know, if it was happening on well, I don't know that it happened to any of our relationships with, you know, any of our affiliate lenders. And Bruce, you haven't had anybody that, you know, one of your originators or lenders put out a pre-approval letter on, got a house accepted and said, hey, we can't afford it now. I think those conversations are happening before the contract stage. Am I correct?
Well, we had it a little bit this week, definitely. But what's nice is that with the Fed raising 3/4 of a point, the market's come back so much to where it was before that these deals look like they'll be able to, not a lot of them, but it did happen. I mean, you can't raise rates 1.25%, and if you have somebody at a 49.9 back ratio, it's a problem. But I don't think, I mean, you know, as responsible lenders, all your lender partners, we're going to, you know, try and lock these transactions. We'll be more aware of it. But the volatility is something that, to this agent's point, it's something that we have to be ahead of the curve on, because if somebody's really tight, the agent needs to know that, the buyer needs to know that, and there are some safeguards we need to put in place to make sure we don't, you know, we've been dealing with a stable market, then we were dealing with a little bit of market that was up and down. Now we're dealing with a real volatile market. So there's pieces to what she's saying that have to be looked at, no doubt.
So in terms,
This is what the TVs, all the networks are talking about. Every day you hear about people cannot qualify any longer. Homes are coming back on the market. I mean, this is what we're all talking about. Every one of the prime channels are talking about it. It's a subject.
We're actually finding a little bit of the opposite, and we're in the process of redefining what the new buyer looks like and the opportunities for them that I'm talking to Rob about as well. But a lot of opportunities there's always opportunities when things fall apart. There's certainly people that are not going to qualify as a result of what's happened, but it's really more those people kind of didn't qualify a few months ago. But, you know, redefining what those buyers look like, and to Rob's point and to everybody's point today, like with the amount of people buying cars and everything else, at the end of the day, the good news is that there's so many buyers out there that we just have to be a little more strategic about redefining who those buyers are so that we can make sure we're working on things that are highest, best use of our time. And we'll help you identify them within the coming week. We'll have some tools and strategies to help you with that.
So,
To that
so,
point-
go ahead.
To that point, Rob, I just want to let everybody know on this call that on Tuesday morning at 10 o'clock, we're going to have a special mastermind with the people from Finance of America, discussing exactly what's going on in the mortgage industry and coming up with strategies for moving forward, and being able to give the agents, the talking points to discuss with their clients, what's really going on and what we can do and what options there are for them. So
Was that, and that was Sarah that made a comment about the news. There's always a story, right?
Well, it's
That's-
hard not to, I mean,
Yes.
basically the news says, oh, the Fed's raising rates. Well, no, they're not. They're raising certain rates. The Fed's actually trying to be responsible and cut inflation. So the gas isn't $12. So there is a different spin. I'm not trying to be overly positive on it, but there's definitely a lot of uncertainty, but the fear is what's freaking everybody out. And we need to be able to identify the people that are out there because there's still a ton of buyers. To your point, nobody's going to stop renting apartments. Nobody's going to stop buying cars. There's too many damn people that need all this. And we just need to have a better lens as to what's available, what that looks like. And we have some pretty cool stuff that hopefully will help out quite a bit.
So Sarah, this is the whole crux of our conversation here is taking control of the message. Because if there's one out of a 1,000 that have a negative story, that's what sells newspaper and advertising time, is talking about that one person that something unsavourable happened to, right? Oh, they could have afforded this house. Now they have to continue renting and their lifelong dream is ruined. That makes headlines, but that's not reality. Okay.
I'm not trying to be pessimistic, but it's just a week since the rate is up.
No, it's realistic. You're right. It's there. It's all over the media. And the goal with what Rob's saying, and we're going to try to help create that, it's not to try to be full of baloney and just say, hey, that's not there. That's not there. You know what? For 50% of the people, for 40% of the people, it is there. The good news is that there's still a ton of other folks left, and identifying those, that's really all we can do as real estate professionals. There's nothing else we can do. We can't change the narrative that's true on some of it. And, it's a reality, and the stock market crashing is a reality. And there's going to be some economic shake. There's going to be some crap going on, but we need to understand how to frame that to help people out. But I don't disagree with you at all. The media the past 2 weeks has been, forget it. World's coming to an end.
Right. But I mean, Bruce, even the stock market, is it crashing, or is it's basically repricing to the new cost of money?
I don't know. My statement crashed, and so did my paycheck crash. So I don't, and I'm just trying to be funny because I'm a person too. We're all people. We all have our houses and everything. None of us want to deal with this shit. But the good news is that we sell real estate, which is typically a longer term investment. The good news is that there's less inventory than there are buyers. The good news is that there's still mortgage money available, and there is a tremendous amount of liquidity in the market, and there's a tremendous amount of affordability because earnings are still up. Now, I will tell you that I think there's some things that are going to happen. They're going to change some of that, but thank God there's so many people and there's so much of a need. And that's really, we have to kind of just say, hey, let's focus on that, because what else are we going to do? We can't change the other stuff,
So
there's not a lot of new construction. The builders are having problem getting supplies and everything. So yeah, people need housing. Where there's a will, there's a way.
And people want honest answers. And if you're able to paint it in a picture like Rob is, and you can paint what this thing looks like at a period of time and what it looks like and what we're dealing with, then you look at the opportunity. And are you the person who wants to take advantage of the opportunity? Now, you either are or you aren't. And if you're not, then we'll get you when you are. I mean, what are we going to do?
Going back to what Rob said a few weeks ago, my agents have been using, if you feel the interest rates are too high now, they're going to go down, you'll just refinance. There'll be an abundance of refinancing.
So if somebody, I sent out the document with the invite. So if you want to look at it, and it will also go out with the recording if you want to go back to this. But there's a contingent of buyers that are waiting on the sidelines for the market to correct. And I don't see that correction happening. And I think if we don't have those conversations like Colleen's talking about, where you win either way, right? And it struck me when one of our agents in Closter was buying a property and the rates were 3.25. They locked in at 3 5/8. Thank you to Neeli for pushing them because they thought it was just going to come back down. They were so angry that they missed 3/8 on the rate. By the time they closed, the rates were 2.5% higher. They were high-fiving, thinking that they were the smartest people on the planet, not knowing that their lender forced them to do it. But think about that perspective, right? If you lock in at a 5.5% rate now, and rates go up to 7.5, which is possible. I don't know if it's probable, but it's certainly possible, right, Bruce? Right?
All about
Caitlin
inflation.
or
Better not, man.
Frank.
It better not. It's all about inflation.
But I mean, it's possible, right? And I don't think we're disingenuous if we say that there's a possibility that rates could go up to 6 or 7%.
The problem is
That's
inflation right
possible.
now is global. It's global too, though, guys, right? I mean, it's global. Like, Europe increased their discount rate. Everybody, I mean, it's global. Inflation's global. It's not just here. So the supply chain, yeah, it's certainly possible. It's definitely possible. But
Now, if you're a buyer and you locked into a 30-year fixed at 5.5 and rates go up to 7.5, now when you did it, you felt like you had to hold your nose and sign, but 2 years later, you're feeling pretty good about yourself, right?
Absolutely.
And then if rates go down, if you're in that camp, right, you just refinance. So flip a coin, heads you win, tails you win is my discussion. Okay, and having a conversation with the seller, okay, is easy because you know what? There's not as many buyers as there were. We're not going to be able to capitalize on the frenzied buyers and bidding above ask price that we used to. We will probably see a normalized appreciation, okay? But if you're thinking of selling, now's a really good time to sell. Now, does anybody find that offensive or disingenuous to have a conversation like that to a homeowner about selling? And then I turned the corner and I talked to their son and daughter who are thinking about buying for the first time and saying, hey, should I wait for the market to crash? And I'm going to say, you know what? Here's the possible outcomes. Okay, there's a small possibility that prices will correct down. The most likely is that we're going to get into balance and normalized appreciation. Okay, and there's a outsized possibility, a very slim possibility that we're going to see something change where the prices are going to continue to rise high, which I don't think. So if we were to buy now, okay, we're going to lock in an interest rate. We're going to lock in a price. If interest rates fall, we're going to do what? We're going to refinance. If interest rates rise, we're going to be doing the high five in each other saying, wow, I really appreciate the advice that Colleen gave me. Okay, and insert your name there because that's the conversation that we need to have. Buyers are putting things on pause out of fear, not out of knowledge. They are not froze from transacting because they're full of knowledge. They're froze because they're hearing mixed stories. When they hear mixed stories from people they don't know who to trust, they freeze like a deer. And the deer in New Jersey that freeze, TJ, what happens to the deer that freezes here in New Jersey?
Usually gets hit by a car.
Yeah, gets hit by a car. That deer gets hit by a car. So freezing is not a good option. Okay. So we need to control the narrative. I want to come back to, and it's not that I'm a disciple of Chet Holmes, but this really, really seems more relevant than ever. And I know most of the people come here for freedom into the real estate business. They love the market. You want to have an opportunity to make a really good living and a lot of money. But I don't think most of us, even the really driven ones, do it solely for the finance and the money. And this just is stuck in my head. If you believe in what you do and you can really help people, then you have a moral obligation to try and bring it to as many people as possible. right? And now more than ever, like, you can change people's lives by, giving them the right information to make the decisions that are going to help, them and their family, where they live, where they raise their kids, whether they have a viable financial investment in years to come. This is not just opening doors and putting for sale signs on houses, folks. This is substantial. Okay. This is life changing. And if you don't step up, I think, our competition will, or there will be people that should have been relying on us that are making the wrong decisions. Okay. So that's my, um, you know, foundational belief about what we need to do. Putting aside, whether you want to make money to buy a new car, or, all those, sales training and coaching tricks where, you have this goal, that's all good. But I think if we're in the business and we hold ourselves out as professionals, and people are looking to us for leadership, we need to recognize that responsibility and that obligation, and bring it to as many people with as much integrity as possible. And then the other quote I wanted to put out there for today, which is, something that I've heard people talk about, when other good markets have kind of normalized, and, the froth have come off the market. We don't want to live life with regrets. Okay. And there's a gentleman named Jeff Bezos who has a pretty big company that we all know of, Amazon, that seems to even be doing well, even though it's beat up a little bit. And Jeff Bezos was a wildly successful, financier, or investment banker on Wall Street, and he gave it all up for a belief that he had. And he's, in my mind, famous for saying this. Maybe nobody else knows about it, but this is a quote I found. When you think about the things that you will regret when you're 80, there are almost always things that you did not do. There are acts of omission. Very rarely are you going to regret something you did that failed and didn't work, or whatever. So, that goes towards, not every strategy that we deploy to have outreach is going to be a wild success. Some of them may be failures, but we need to continue and move forward, and not have regret for not trying, right? So my mission and my passion for these sessions that we have, the hour that we spend together, is to influence everybody that's here to take that message to the public, to our sphere, our friends, our family, and break the media hype, the disinformation that's going out there, or the selected information that's going out there that's giving people fear. Okay. Does that resonate with anybody here? Does anybody feel that passion that you have to, when you have a mission, it's a lot easier to communicate to somebody than when you're just on a pitch.
Rob, something else that some people can do, if they actually print out the last 30 years worth of mortgage rates to show a buyer who's scared, it really just shows that the rates are still good. And the reality is we're just back to a more normalized rate instead of what was crazy low. That was a fluke that we were in such low mortgage rates. And this is just normal again.
All right. Who is SMG 98 that was just speaking? If you want to just announce yourself.
It's Scott Kaplan.
Oh, Scott, the secret SM agent. So Scott, I think that you're absolutely correct. And one thing that I'm going to just put on the fringe here is, sometimes the more we talk about something, the more it gives credibility, even if we're trying to prove a point. So I think, saying, hey, over the past 30 years, this is still lower than the average rate. And rather than tell somebody, you know what, Scott, if we buy now at 5 3/4 and rates go down, you're going to refinance. If we buy at 5 3/4, rates go up, you're going to feel pretty good about it. And this is something I want everybody to write down, is when you're having that conversation, okay, and say, historically over the past 30 years, these rates are, even at 5 3/4, lower than the historic rate. Now, Scott, if we buy this house that you're looking for your family, I know you need the extra bedroom and the den. If we buy it now at 5 3/4 and interest rates go up, how are you going to feel about your purchase? If rates go to 7 or 8, how are you going to feel about it, Scott? Role play with me.
Yeah, you're gonna feel great about it.
And now, Scott, this is your second time, or no, your third home you're buying. I remember, you bought a condo, then this house. So, Scott, if interest rates fall, what are you going to do?
Probably refinance if they fall.
You fall and you'll take advantage of it. So, would you agree that this is a win-win situation with whatever direction rates go?
I think so, yeah.
Fantastic. So I think that's the way that we, in my opinion, and I don't sell a fraction of the houses that everybody on this call does, but I want to make a contribution to helping you have a clearer message so that you get people to act with knowledge, certainty, and not be frozen by fear. All right. And as long as I've been in the industry, I've seen a lot of really intelligent, smart people that are telling people what's going to happen and how they should behave rather than asking them the right questions to let them draw that conclusion. And I think with a little bit of data, Scott, and the leading questions, and they're not manipulated in a negative way. It's not a fraudulent, deceptive practice. It's just asking them those questions to get them to decide whether that would make them feel good or not.
So Rob, can I chime in real quickly? So one of the things, depending on who I'm working with in a conversation, if someone were to ask, oh, what do you think of the rates? It went up to 6%. And I just had this conversation with the buyer. I said, I don't know, buyer. I was all excited. And when I bought my first home, I didn't even look at the rate. I was just excited about getting my first home. Little did I know at the time that I was paying 18% interest. So I don't know about 6%. To me, it doesn't sound that high. So I just try to use that. Again, you got to look at who you're working with. So, and then my word of the day that I've come up with based on what you asked and how we handle like the media conversation, it's 2 words. It's worm castings. I was working in my yard early this morning with worm castings. So that's going to be my answer when you hear about, the media says, well, it's a bunch of worm casting. Worm castings, for those that don't know, is worm poop. So it's going to be my answer.
So, Jim, I think you have a unique way of garnering people's attention, and we need to find our style and find a way to exercise our moral obligation to help as many people as possible. If we're committed and we believe in what we do, we need to get that. We need to get the narrative to the consumer and let them make the decision. And if there are some people who just don't feel comfortable, as long as we present the information, we just move on and we go next.
Yep. Next.
All right. So it's a powerful word, next. But I learn from all of you. I appreciate the dialogue here. I'm going to stay on for another 5 to 8 minutes. If there's anybody that has any, personal challenges that you've come across in the past week or month with regard to the changes, and maybe we can solve those together. So this is not for the bashful.
No, but what's going to ask you about that? This is Tony Burrow. If you can put in the bullet point there, and so that way we can show to the buyer or sellers, about all the changes coming up, how to deal with. That'll be great. That would be great.
So when you say put in the bullet point, I'm not sure what you mean, Tony.
All these points that we think and we heard that buyers and sellers are concerned about it. So if we have all those, like, the interest rate are going up. So we have there the bullet point, the interest rate going up. What is to look at? What is it that we have to look for? How do we explain that to the consumer?
So part of this, Tony, is probably come back to the discussion that we have here, because sometimes words and writing words, this person says this person says that, loses meaning. But I think we need to feel comfortable in having the conversation with a client. Like, I really feel, that, heads you win, tails you win with interest rates if you buy now, right? And in terms of, hey, I want to sit in the sidelines until prices adjust. Well, you know what? Now is the time to go, because there are, 2 or 3 houses that you might be able to take a look at. Okay. And you might be able to be a successful bidder without bidding 100,000 over asking. I think this is a tremendous opportunity before rates potentially increase further. And then you take that narrative into what would happen if rates continue to go up. If you're renting, what do you think is going to happen to your rent? And let them answer those questions that are going to draw them to the conclusion. And I don't think I want to draw people to a conclusion that is not in their best interest, but I don't want them to feel bad about taking action. Okay. Home ownership is still part of the American dream, right? Let's not let anybody rain on our parade. Are there any other questions that anybody has? Because I'm sure you have them in your head. That's why you're on here. What's a challenge that you're having when you're talking to a seller and a buyer? And I'd like you to think about, talking to the parents that are selling their house and never going to buy again, and the daughter and son or the daughter and son-in-law who are going to be buying for the first time. How can you thread that needle where it's a good time for both?
Well, Rob, hi, this is Mondi. I have a question, not along those lines of what you just spoke about, but I always had a question just around mortgage points and the cap on that. Like, how many points a person can buy? Is it only like 4 points that they're allowed to buy down?
So I'm going to let that go to our lenders, and I'm going to just start it off by just saying that mortgage points are prepaid interest. And maybe Caitlin or Dan, I know Bruce, you're always the source of knowledge.
You got Frank.
That's-
Or Frank.
Yeah. Hey guys. Good morning, everybody. No, that typically it's there's something called high costs where you can't pay more because we have it's more of a balance in check. But typically it's 3 points, and for every point that somebody pays historically, it takes about 0.25% off the interest rate. But and like Rob said, all you're doing is prepaying interest. So generally it's up to 3 points, depending upon the loan amount. The higher the loan amount, it works out better. But for standards, it's just about 3 points you can pay. And there's about a 5-year recovery period for those points that you pay. So for somebody in this environment right now where hopefully we don't know, I mean, historically, the market does correct itself and come back and interest rates will come down, and that'll set us up for a refinance boom. Some people are skeptical and they don't want to pay the points because they know within maybe a couple of years the rates will come down and then we can refinance them. But there is typically a 5-year recovery period, whether you pay 1, 2, or 3 points. So I hope that helps.
And Mondi, I have a suggestion for you. And this goes for everybody, is, when you have that curiosity, participate in the conversation with one of your trusted lenders, because that's really what educates you. When you hear it play out live, and the people that are on here on our lending side are all vetted people that I'm comfortable will provide the right information. Is that helpful?
Rob, I got a challenge that some of my buyers keep asking me, and this could be a question for the lenders as well, is that they're already paying above, appraisal values in some cases, and now interest rates are higher. And their question is, hey, what happens if, the market changes and interest rates go lower? I try to refinance, and now I can't because I'm underwater. The value of my house now has gone down, and now I can't refinance.
So Gary, I'm going to take that one because I think that's a risk question, right? If they buy now and the rates, the values precipitously drop, or they pay substantially more than what it appraises for, that's a risk, and that's just the same as the risk of the infamous buyer that signed a waiver of the home inspection and then came back to regret it. So I think we need to have integrity and say, look, if you do pay above appraised value, there's a risk if you're 80% loan to value that you might have an issue refinancing or, I don't know. I see, Dan, you have your camera on. If somebody pays more, they put 20% down and then 10% goes away, can they then refinance and pay PMI for a couple of years?
They could. I mean, I'm running into that with a couple of investment owners now where they bought, I mean, they came really close about a year ago to like 90%, loan to value, and they're trying to do it now. And it doesn't work, but you could pay PMI. PMI is there. You know what I mean? So once you get that loan to value down below 70%, it'll go away. So it's not forever. You know what I mean?
And Gary, I feel like the irrational overpaying is going to be muting a bit. Okay. And if somebody's looking to buy, say, hey, look, maybe you need to be a little bit more responsible. Maybe you need to make sure you're only paying 5% above what it would appraise for.
Hey, Rob, you understand that their fear is that, let's say a year down the road or 2 years down the road, that if interest rates, even let's say they drop to where they were 6 months ago, that the house value is going to be much lower than it is that they bought it for, and they're not going to be able to refinance even at the lower rate because it won't appraise.
So I would go back and talk about the data and say, look, that's a decision that I'm not warranting what home prices will do, Gary, but here's what the experts are predicting. And here's the option. If it goes down by 10%, you can pay PMI for a year or two. And I guess in the absolute worst possible scenario, they have to be comfortable with the mortgage rate that they have, because what happens if interest rates never come down? They're stuck with that rate. If rates go up, they feel pretty good about it.
To Gary's point, though, I'm finding that, we're talking about what we're finding and the fears we have. I'm finding that the buyers that we speak with, because the buyers that are still out there, they obviously still qualify. I'm finding that the buyers that we speak with are more concerned about value dropping than they are rate. And I think us having that mission to be able to talk to them about that is important, because, we obviously we can't control values, but it's a legitimate question. But I think to the point though, Gary, that's not that buyer. That's the buyer that's going to maybe not be the best buyer in this market. That's just fear in general for both things, so that's a tough one.
So Bruce, I think if we educate them on what a correction or what an adjustment means, I think that it allows them to look, if historically prices have gone between 3 and 5 or 4 and 6% annually, and we still have less housing built and available than people that want to buy it, Gary, what do you think that's going to do to the housing market, even in terms of rates going up and sentiment, turning a little bit down from where it was at irrational levels? And if you think that the housing market's going to crash 15 or 20%, then maybe now's not the time for you to buy. But in terms of what Gary Nagurka and Rob Lazar think, I would have to have my opinion, and I'd base my opinion on fact. It's not a guarantee, right? When somebody sells you a share of Apple stock, if they sold it to you 3 months ago or 3 years ago, they probably had that same conviction. If you bought it 3 years ago, you're like, I'm a genius. If you bought it 3 months ago, you might be like, that was really a bad decision. Okay, but you make your decision with the best available information at the time. I hope that's helpful, Gary. And I think the more you get into the minutia and the details, the more that you give them reason to pause. And I'm not ever saying that you want to be disingenuous, you want to mislead them that prices will never fall, because that's not a reality. But the reality is that the likely scenario is that price increases, mute a bit to still being positive. We have one other challenge that we can go over before we drop off.
Rob, there was a question in the chat box. What about people who buy investment property? Should they buy now or wait a little bit?
That's an easy one for me. It depends on if it makes sense to buy. If it's positive income, you buy. If it's not, then you don't. But I would feel like with, my own opinion is with the instability in the financial markets, that if you're a long-term investor, you know exactly what you're getting. If you're going to buy it and try to flip it in a year, there's risk there. Any other questions? I know that there are other questions out there, because I feel the apprehension and the tension in talking to our clients and being able to have that positivity, because sometimes we are afflicted by that same media drama that's out there.
Rob, a positive note also that people can use with the clients who have some fear factor. If they are paying rent and you take their rent for 1 year, most likely their rent is going to be equal to a 10% drop in price, that it wouldn't make a difference whether they did now and it dropped 10% or not. It actually ends up being the same way. In a lot of cases, it would still be cheaper for them to buy than to keep paying rent for the next year and find out.
Excellent point. So we have a bunch of shy people on here, Robert. Nobody's either. Everybody is empowered to have these conversations, and our sales are going to be going up while Redfin is dropping, or we have some shy people.
I'm going to go with your first option.
I love that. Sharon, I'm going to say going once, going twice. Any other questions? All right. Well, everybody have a great weekend. Take the message to your buyers and sellers. I think this is a great opportunity. We control what we put in our mind and what our opinion is. Nobody can do that to us. And we have a moral obligation to get that out to our sphere, clients, prospects, everybody. Have a great weekend, everybody.
Happy Father's Day, everybody.
Thank you.
Happy
Thanks,
Father's
everybody.
Day. Bye.